How does Sharpe ratio improve crypto backtesting results? Imagine trying to pick the best crypto trading strategy just by looking at how much money it made in the past. It might seem simple, but it can be misleading. That's where the Sharpe ratio comes into play. It helps traders see beyond just raw profits and understand how much risk they are taking for those gains. When you backtest a strategy on a crypto exchange or with trading tools, you generate a lot of data. Some strategies might look great because they had high returns, but they could also be very volatile. The Sharpe ratio helps you compare these strategies fairly by showing how much return you get for each unit of risk. To calculate the Sharpe ratio, you subtract the risk-free rate, which is usually the yield on a government bond, from the average return of your strategy. Then, you divide that by the standard deviation of the returns, which measures how much the returns fluctuate. A higher Sharpe ratio means you are earning more return for the risk you are taking. A lower ratio suggests the strategy might be too risky for the reward it provides. Using the Sharpe ratio during backtesting offers several benefits. First, it allows you to compare different strategies or parameter sets based on risk-adjusted performance. For example, a strategy with slightly lower returns but much lower volatility could have a higher Sharpe ratio and be a better choice. Second, it helps you spot overfitting. If a backtested strategy has an extremely high Sharpe ratio, it might be too closely fitted to historical data and may not perform well in real trading. Monitoring this ratio keeps you grounded. Third, because crypto markets are very volatile, considering volatility explicitly with the Sharpe ratio makes your evaluation more realistic. It ensures your strategies are not just profitable on paper but also manageable in real-world conditions. Fourth, it standardizes performance metrics across different assets and timeframes, making it easier to compare strategies. Lastly, by subtracting the risk-free rate, the Sharpe ratio accounts for the opportunity cost of capital. It shows whether your crypto strategy is worth pursuing compared to a safe investment like a government bond. When you use trading tools and backtesting platforms on crypto exchanges, calculating the Sharpe ratio over your backtest period helps you identify strategies that balance returns and risk. This way, you can focus on strategies more likely to succeed in live markets, where volatility and drawdowns are common. In short, the Sharpe ratio sharpens your view of how well your crypto strategies perform when risk is taken into account. It helps you avoid overly optimistic results and find strategies that truly stand a better chance of working in real trading.